Okay, so in this video I'm going to be doing a quant analysis of a strategy that a friend of mine asked if I could code up and analyze. It's one that him and I had talked about before, and basically the idea was that if you have a gap up followed by selling pressure that puts the closing price below the volume weighted average price, then you should short the market and use a tight stop, and that this would be a day trade, and then you would do the opposite for gap down. So essentially, you have a gap up, then you have selling pressure, and the idea is what happens if you short the market when the closing price goes below the VWAP. And I think in this video you're going to be maybe surprised at the results. I know a lot of people like using the VWAP, and we're going to just kind of get into it here and do a quant analysis of this technique. I think, like I said, you'll be surprised. But let me go on to the outline of the video. So number one, I'm going to code the strategy. We're going to use a finite state machine. I'm going to show you the code. Then I'm going to show you the initial findings. Basically, after you code it, when you do when you run it in TradeStation, you get the full trade report that gives you the profit factor, the percent profitable, the number of trades. We're going to review the good trades, the bad trades, and then I'm going to optimize the inputs and see if we can improve. And then finally I'm going to summarize the findings. So I'm trying to do these videos a little bit faster so that we can get straight to the content, but let's do the disclaimer first. So Algorithmic Trading, we are not a registered commodity trading advisor. We're not a licensed one, so we claim the self-executing exemption granted by the NFA. But keep in mind that trading futures involves substantial risk of loss. It's not for everyone. The results that we're going to be talking about are hypothetical back-tested, so if you want to pause this video, this slide, feel free to. We'll do the next page. And keep in mind, this is really for educational purposes only. I'm not recommending any strategies in this video at all, just showing the findings of the data that we looked at and the algorithm that I looked at. Okay, so let's start with this. I basically took a picture of the email that he sent me, and him and I were talking, and I asked him to just kind of email me the idea that he had with the VWAP, and I think it was an idea that was taken from maybe a blogger, another guy that does some videos. But here's what he wrote. So if the market gaps up significantly and then retreats from the morning highs, sell short when the price drops below the day's volume weighted average price, and then use a tight stop and get out at the close unless it's stopped out earlier. And then basically do the opposite if you have a gap down. And he mentions that the primary advantage is that you can use a very tight stop, limiting the losses on false positive trades. And he mentions, he has no idea how to define a significant for the gaps and how tight of a stop. So, perhaps the optimization can determine those variables. So, with that, let me go ahead and start. Let's look at a chart, and I'll kind of show you what he means. So this is a chart of the S&P E-minis. These are using 1-minute candles, and I do have a session set that limits the trading or the chart for only when the equity markets are open. So what that does is it creates gaps very similar to what you would see if you were looking at the SPY ETF. But again, this is futures, so it's they do trade for the most part 24 hours. So we have to limit the session to only be trading when the equity markets are open. But the idea is that I'm going to go ahead and add a analysis technique called my VWAP, and that's just code that I took. I actually took some of it from TradeStation so that we could get the volume weighted average price on the chart. And so if I kind of zoom in, let's look at yesterday, and I'll kind of show you the trade idea. So let's see if I can kind of zoom out here, but yeah, so the idea is that if you have a big gap up like you have here, and this is the 30th of November, this here is the 29th, so you have a gap up, and what happens is the volume weighted average price starts accumulating for that day, And what happens is the more volume that you have, the bigger impact it can have on the moving average. But essentially what you have is a gap up followed by a little bit of a rally, and then eventually you have a close below the volume weighted average price. And the idea is that you would go short at this point and then have a really tight stop. And let's just kind of look at this day, and I'll kind of zoom out here so that we can see it. But if you would have gone short when you had that first close below that volume weighted average price, and also within a window, so it's in a later email he mentioned to use about an hour window. So if it happens kind of 5 minutes after the market opens until an hour after the market is open, what we're trying to capture is a bunch of a big gap up, so you have a lot of strength, but then kind of a potential change in trend direction. If you look here, that would have worked really good yesterday. I mean, you would have gone short here and then covered at the close. So so that's kind of the basic idea. But let me go back to my slides and we'll start looking at what I did. So this is a finite state machine of the strategy that he wanted me to do. And people that have watched some of my other videos, I talk about state machines at times. But a state machine is basically something, it's a data structure that allows us to kind of capture what the intent is of the algorithm. So you go from a reset state to an active state. The reset state is just kind of initializing variables, but when you're in the active state, that's really when everything is happening. But the idea is that if you have a gap up, then you kind of go to this gap up state. And what state machines are used for, and then if you have a gap down, you go to the gap down. And if neither of those happen, then you just stay in the active state. But what state machines are used for is to they're used primarily by logic design engineers, which that's kind of what my background was. So these seem like a natural way to kind of code algorithms for me. But if you have what they do though is they allow you to capture sequences of events. So instead of just kind of a linear algorithm that just kind of goes step by step through what you want to do, a state machine allows you to capture states and sequences of events. And in this case, what we wanted is number one, a gap up or a gap down, and then followed by a kind of a cross, either a bearish cross or a bullish cross, where you have that close below the volume weighted average price. And so if I walk you through this, so basically if we start in the reset state, we immediately go to the active state. And if you have the gap up, then you go to the gap up state, and then you stay there until you have that bearish cross. And if you have the bearish cross, then we go short, and then we stay there until either the market closes or we get stopped out. And that's what this other kind of arrow shows. So from the cross below state, you go to the active state when you exit the position, and then you start over the next day. And kind of the opposite happens on the gap down. So you go from active to gap down, and then once you have the gap down, you go to cross above, which would be the long trigger, and then you go back to the active state once you exit the position. But the initial inputs I set up are a tight stop, a gap setting of +4 and -4. So what that represents is how big of a gap we want to see for this trade to be possible. So like in this case, if you go to, and I'm on Mountain Standard Time, so these times are Mountain Standard that it shows. But at the close on the 29th, we closed at 2203.75. And then we opened the next day at 2211.25. So that represents a gap of, I don't know, about 8 points, 7 to 8 points. And what we're saying is, if you have a gap of 4 points or more, then this trade could occur. So that's what the gap setting is, and then -4 is for the gap down. And I set it for a 1 hour window where the buy could happen between 9:35 and 10:30 Eastern. So essentially, kind of between, for me, that's kind of 7:35 until 8:30, which would be kind of in here. So it gives you this hour window where this trade could occur. And the idea behind having the hour window is that you want to enter close to the morning after the initial gap has happened. He didn't want it to enter kind of at a later time, kind of like back in here, where the potential move has already occurred. So he only wanted to do it kind of at the open. And that made sense on a first pass for sure. So he didn't want a limit order. So his rules that he gave me said if you get out when you have a tight stop is hit or the market closes. So here's the inputs from the code that I have here. But let me kind of let's take a quick look at the actual code now. Okay, so here's the code for the VWAP plus gap algorithm. So I have the inputs set up, I have some variables. Here's the VWAP calculation, and again, you can just pause the screen if you want to look closer at this. I won't go into what we're doing here, but it's basically creating the volume weighted average price. And some of this I copied from what TradeStation had, just to make sure I didn't have any errors in that. But to define a gap up or gap down, we basically have if the time is 7:31, so we're at the basically the open candle, and the open minus the close from the previous 10 candles, and the previous 10 is just an estimate of the closing price when the equity markets close. But if that's bigger than the gap, basically because on this strategy session we actually go until about 10 minutes after the market closes. And so that's why we go back 10 candles here. But if it's bigger than the gap up size, then we just set these flags for a gap up or a gap down. Here's where I have the buy condition being met. If you have a close of the current candle that's bigger than, so this is for the gap down case where we want to buy. If you have a close that's bigger than the VWAP, and the previous close was less than the VWAP, so this signals that bullish cross, and you're in the gap down state, and the time is bigger than the start window and less than the end window, then that triggers the buy condition, and then the sell condition is kind of the opposite. And so here's the actual code where we place the buy, and then this is some other code that I added for enabling a stop or a limit. So I set it so that we could try it with a stop, without a stop, and then with a limit or without a limit. And I set it so that we could have separate stops for the short and long, and separate targets for the short and long. And then here's the actual state machine code. So if we're in the idle state, then we go immediately to the active state. And when you do a state machine like this, and this is just the way I do them, there's probably a few different ways you could do them, but really all we're doing is we're setting flags that signify kind of the current state. And just remember, when you have a state machine like this, you only want to have one true state transition. Otherwise the state machine can get out of sync and kind of go into kind of who knows land. So for all these kind of state definitions, there's only going to be one true. So from idle you go to active, and then once it loops through the second time on basically the second candle on this chart, then it's in that active state. And really all we're doing is we're looking if either we have a gap up, then we go to the gap up state, and if we have a gap down, then we go to the gap down state. Otherwise we stay in the current state. So then once we're in the gap up state, if we have a sell condition met, which is that bearish cross, then we just go to the cross below state. And again, if I pull up the state diagram, you'll kind of see these. So if we're in the gap up and you get the bearish cross, then you go to the cross below state and we're short the market. Okay, and then what this is, so right here is basically there was a condition where we could be in the gap up state. You have a gap up, but the sell condition is never met. If that happens, then we wanted to make sure we still went back to the active state. And so that's all this is. So if the time is bigger than 2 o'clock, meaning and that's Mountain Standard, if the equity markets close, and we haven't had the sell condition, then we want to go to the active state for the next day. And then if neither of those happen, then we just keep looping in the gap up state, basically waiting for the sell condition to be met. And then we kind of do the opposite on the gap down state, so I won't go through that. Then once we're in the cross below state, meaning if I go back to the diagram, we're in this state. So whoops. So we had the gap up, and we're just waiting for that bearish cross. So once we're in, or I'm sorry, we had the bearish cross, and now we're just short the market. So once we're in that state, all we're doing is we're waiting for either the stop to be hit, which would be our market position is 0, or the time is bigger than 2 o'clock, meaning the market closed. Once that happens, then we go back to the active state. And if that doesn't happen, we just stay in our current state. And then the opposite is true for the cross above. And then the final piece of the code is just setting exit on close. And if this was a strategy we were trading live on TradeStation, we wouldn't be allowed to use this set exit on close. I'd have to actually have code that just exits, does a sell order when the close happens. But for the analysis, that's just an easy way to do it. So that's the code. So let me go ahead and add it to the chart now, and I'll show you kind of what came out of that. Okay, and so what's happening here is I've enabled the algorithm to be basically applied to the chart, and because this is a 1-minute chart with a lot of calculations, it just takes a while to load. But so we're kind of just waiting for it to apply the strategy. And in this chart, even though right here we're just looking at the 30th of November, it actually goes all the way back to May 1st of 2003. And so that's what's taking so long, is it's a whole bunch of trades that are basically being added. And it looks like it applied it okay. And so if I kind of zoom out a little bit, we'll kind of see some of the different trades being applied. So here's the first one where you have the short trade, and the dotted line basically just means we went short here and then we got out here. And if you look over here, you'll see a case where it would have bought on this gap down. It would have had a close above the VWAP, so it would have bought, but then it would have got stopped out. But let me go back to let's go back to the slide deck real quick, because I want to show you an example of a good trade and a bad trade, or a good trade that's short and a good one that's long. And I took these pictures of the chart just to kind of show you, but here's an example that we were just looking at where it worked really well. You would have had a great short trade. You had the gap up and then weakness. We would have gone short with a tight stop and would have had a gain. Here's an example from the 23rd of November where we would have kind of done the opposite. So you would have had the gap down, a little bit of weakness, and then it closed above the volume weighted average price, went long with a tight stop. So these are examples of really good trades, and probably where this idea originally came from my friend. So if we look at a bad trade though, here's an example of a bad one. So we would have had a gap up on the 21st of November, and then it would have actually closed below the VWAP, so we would have gone short, but then a rally that would have stopped us out. And then here's a trade on the 28th where we would have gone long and it would not have worked very well. So if I go back to the chart, we could look at a few other trades. So I don't know, I'm just kind of scrolling back in time. Here's the 6-4 in 2010 where it would have had a bad trade. Here's another trade on the 3rd of June where it would have gotten out at the close for pretty much a break-even trade. And you can just kind of scroll through time and find all kinds of trades. Here's another one on the 21st of May that would have been good. Here's one where it would not have worked out as well. So if we so I think what we'll do now that you've seen a few trades on the chart, is we'll go ahead and start looking at the results of this. All right, so all I did is in this kind of step 2, we're just going to summarize it now. So after so this is just a snapshot of the performance report from TradeStation, and what you'll see is that this strategy actually does not do well at all. And so that, I have to admit, was a little surprising. I thought it would do a little bit better than what it did, but I'll just kind of pull it up on TradeStation now instead of the slide, so you can kind of see. So it's from May 1st, 03 until December 1st, 2016, which is today. And the first thing that sticks out is the profit factor is really bad. 0.77 means that this is a losing algorithm. The percent profitable was only 25% on the long trades and 27% on the short trades. It did have a lot of trades, which is, we always like to see that. So 1,411. If somebody traded this strategy from the beginning of May and 03 until now, they would have had a big drawdown of $56,000 per contract traded. If we look at the equity curve, it's really bad. I mean, it's about as bad as it could get. Basically just straight down. You will see these blips where it had good, some good trades, but the overall trend is pretty much straight down. So let's go back to the slide deck. So overall, the first pass is that this is a horrible algorithm. And I'm showing this, a bad algorithm because, I just wanted to show how a lot of times when technical traders look at a chart, it's very easy for them to miss some of these details that when you code up the algorithm, become pretty clear. So if someone was looking at this strategy, I don't know, this is probably a bad example because I think they would have noticed, but it might be easy to just gloss over the fact that it would have gotten in at certain times when maybe you didn't expect it. And when you code the algorithm, you have to be extremely precise. You have to actually identify what the stop is, what the window is that you're trading, just all the details that are very easily overlooked when you're just kind of looking at a chart. But what I wanted to do with this strategy though is do some more analysis and just see what happens if we add a stop, or if we schmoo the stop, if we trade without a stop, what if we use a limit order, what if we change the definition of the gap up to, instead of 4 points down, maybe we require it to be 20 points, some really big number. And so with algorithmic trading, with quant trading, we're able to do a really in-depth analysis pretty quickly. And so that's what we're going to do next. And so we're going to go through and I'm going to show you how changing all these different things affects this algorithm to see if we can get maybe profitable. I kind of doubt it will be. I've already looked at the data obviously, but if I was doing this in real time, after looking at this equity curve, I wouldn't do a lot of further analysis because this is so bad. In fact, the first thing I would do is start looking at what if we did the opposite. But I wanted to do this in depth mainly because I had the email from my friend and I wanted to just kind of do a full analysis so that he could see. And in the end, I thought it would be helpful for other people as well. So we're going to look closer at this to see what happens as we modify the algorithm. Okay, so the first thing I did is I ran the algorithm with the stop turned off. So the original idea was to have a tight stop, but we wanted to see what it did if we don't have a stop. Because the idea being, are we maybe getting whipped out of trades? And if I look here, eventually I'll find probably a good example. And it looks like the market just closed actually, but if I don't know, if I keep looking, eventually we'll find an example where the original trade idea was probably good, but we got stopped out of it, and it kind of whipped us out of the trade. Because I'm having a hard time finding one, but let's just go back to the slide deck, and I'll show you the result anyway. So without the stop, remember our original result was 0.77 on the long trades and 0.77 on the short. And with this number, It's just a ratio of the total of the gross profit to gross loss, and so we want this to be positive. We want it to be something above 1.3 ideally. 1.7 is great, but 0.77 is not even above 1, so it's actually just horrible. But without the stop, the long trades improve a little bit, and the short trades get worse. So what that tells us is that changing the stop really doesn't give you a good enough improvement, but it's a little bit better on the long trades. So what I wanted to do next was add the stop back and then just shmoo. In other words, run a back test where we change the stop from $200 all the way up to $800 and see what happened. And I'm not doing this in real time because it actually takes a while to run because it's 1 minute candles. So I just wanted to show you kind of the final result. So without a stop, it doesn't really help enough. I mean, it helps a little on the long trade, but gets worse on the short trade. So I'm saying that that's no real improvement. If you turn the stop back on, and I did the long stop, and then you shmoo from $200 all the way up to $800, it turns out the bigger the stop, the better. But it's still not a huge improvement. So what it came up with is if you use an $800 stop, the profit factor is 0.83. So here's our 0.77, and that matches with what we found here, where if you don't have a stop, it does a little bit better. So if you have a stop, but it's a bigger one, then it also sees improvement. But it's not enough to really breathe any life into this algorithm. So changing the stop really has no effect. I was very curious to see what happens if you have a limit order, though. So the original idea was to just get out at the close unless you're stopped out. What I did is I modified the algorithm, and basically all I do is I go to Format Strategies and then Format. And because I had this code for a limit order being enabled, I just set that to true. And then I set the limit to $500 on this one. Then I do OK and close. And so now it's just analyzing how it does if you have a limit order. But let me go back to the slide deck so I can just show you the result. So if you have a $500 for the long and a $500 for the short, you do get some improvement, but again, not enough to breathe life into this. But what it tells us is this algorithm does a little bit better if you have a target, if you get out when it hits a certain target. I wanted to just see, okay, so this is probably the biggest thing that I was curious about is the gap size. Remember, in all the analysis we've done so far, the rule for whether or not we count it as a gap up or down was 4 ES points. And we wanted to see what happens if you shmoo the gap size from 2 to 20 and you do it in increments of 2. So all that's doing is saying we only want to get in the trade if you have a gap size of between 2 and 20 points, and we wanted to shmoo to see what happens if it's 2 points, what if it's 4, 6, 8, all the way to 20, basically to see if the gap size has any effect on the trade. By the way, here's that case that I was looking for where not having a stop would have worked, where we kind of got whipped out, because this one we would have gone short. And let's see, I guess maybe we weren't stopped out. Oh, I'm sorry, this is because I enabled the profit target, that's what it's showing now. But if let me do this real quick. So if I go here, I'm going to turn the limit back off, and then also the stop. Actually, the stop will leave on. And while that's calculating, let me go back to the slide deck. So the ultimate result when we shmooed the gap size from 2 to 20 is that it picked 14 as the most ideal gap size. And what you see here is that the smaller the gap requirement, the more trades you have, which makes sense, and also the worse performance. And so once you get into this range of about 14 points, and that would be a pretty big gap up. I mean, that would be, the Dow gapping up by maybe 100 points, somewhere around there. That's when this algorithm does the best, but it's still not good enough to be anything that we would consider, because it's still negative, number one. It's not even positive, but it does get some improvement. And if we do the same thing on the short, so that was the long, for the trigger for the long trade being 14. If we do the same thing on the short, then we see a similar result where the bigger the negative gap, the better the algorithm performs. And it actually gets up to 0.91. And again, we want this to be above 1 to begin with. But even with it being above 1, we want it to be 1.3 or something that actually could be profitable. But if you look at the total number of trades, of course that goes way down because there's not as many occurrences where you have a big gap down. But it does confirm, or it kind of confirms what the long side saw as well. So one thing we've gotten out of this so far is that it does a little bit better if you have a bigger gap, but it's still not even profitable. Okay, so now that this has populated, so what I just wanted to show you that example of us getting whipped out of the trade, but I put it back to having a stop, the tight stop. You can see that we would have got stopped out, but it would have been profitable if we didn't have a stop. So that's the kind of thing we're looking at when we shmoo the stop, to see if if maybe, I don't know, a 10-point stop is better than a $200, which is 4 points. Or maybe it works best if you don't have a stop. But we did look at that, and as I showed, it didn't really have any good results. So let's look at the next thing we wanted to look at, though, and that's changing the window size. Okay, and just to remind you, what the window size is it's the period of time where we look at it potentially entering this trade. The idea being that we didn't want to get into the trade if it was kind of midday. We wanted to only do it if the kind of in the first hour that the market is open. But if I let me show you the code again, so we can talk about what this is doing, and for any developers out there that are new, maybe this will be interesting or give you an idea of how you can do this kind of thing. But all I did is on my buy condition requirement, and again, this is in the state machine. All it is this point here is when we're in a gap up state. So we've had the gap up, but now we're waiting for the second event, which would be a bearish cross. But if I go back to this window, here we go, the window size. Let me show you the code, because all it's doing is we have a window start, so we want the time to be bigger than the window start and less than the window end. And there's probably a ton of ways this can be done, but the easiest when I did this was just to define a kind of an integer, which is really the time, a start time and an end time. And this is, again, Mountain Standard. But when we shmoo this, because it's not using an actual time, there's not like a time variable that I could say 8 o'clock all the way up to 11 o'clock. So we have to do it as a number, and all it does is I did it in 15-minute increments. So it started at 8 o'clock for the end time. So I wanted to keep the start time the same, which is 7:35 or 9:35 Eastern. And the end window is what we wanted to increase. So I wanted to start a little bit before, which would be like 8 o'clock. So that gave it only kind of a 30-minute window to trade, all the way up to a few hours, all the way up to, I think I actually went up to 11 o'clock, or no, to 12 o'clock. But in this screen capture, it only goes up to 10:25, which is what that would be. You'll see these times like 8:75, 8:60, and 8:90. Those are basically ignored, so they're treated as basically 9 o'clock, I guess. And that's why it doesn't really change here. So these are kind of ignored, but it does eventually get back into the window that would be an actual time, like 9:05, 9:20, 9:35, 9:50. But what we're looking for is how it affects the profit factor. And because this algorithm really isn't good to begin with, it basically picks the shortest time window because that means the fewest trades. But it did pick 8 o'clock, and it gave it a profit factor of 0.86. And you see as the window gets bigger, the worse this algorithm does, which really just means the fewer trades, the less worse it does. Okay, and you'll see it makes sense. As the window gets bigger, you have more trades. But again, it's just picking the shortest window. Okay, so now that we've looked at the window size, and again, it really doesn't help to have a bigger window. In fact, it hurts. But once I was done with that, the thing I really wanted to try was what happens if you do the opposite. And that's kind of the final thing that I did in this analysis. So all I did was instead of shorting when you have something like this, I wanted to see what happens if you buy. And the idea being that you have strength followed by some weakness to where it crosses below the VWAP. Then what happens if you actually buy it? And this example here is still short. But in the code, all I did was flip the buy and the shorts around, because I really thought maybe we would get some traction. But in the end, it really didn't help. So I set all the inputs back to the original inputs, and you'll see that it went from kind of 0.77 to 0.9. So it did do better, but still nothing that could be traded. And you might wonder how that's possible. If all you're doing is the opposite, shouldn't that original equity curve that we had, where it was just kind of straight down, I'm trying to find it, this one here, if you do the opposite, wouldn't it just go straight up? And the answer to that is no, because you still have stops that you need, and so it'll still get stopped out of trades. But it does do a little bit better, as you can see on this final equity curve. But because you have to have stops, it still gets whipped out of trades, and it just didn't work. So I think now what I'd like to do is just kind of summarize all the findings. All right, so the things that had a positive impact was having a bigger gap requirement. For sure that helped, but still not enough to make this algorithm something anyone would consider trading. What also helped is to flip the buys and sells, basically to do the opposite. And that's probably the big finding out of this study, is that in my opinion, the original strategy was completely broken, but if someone did the opposite, it would still be broken, but be a little bit less broken, which is always interesting. And this is something that a lot of quant traders find out early on when they start writing code and actually analyzing these things, is that usually, and I guess I don't fully know why. I mean, I could maybe try to explain it, but it tends to be the case that when you do the opposite of what you think is the right thing to do, that many times is better. So everybody wants to get that huge trade where, let me find it, where you have this kind of thing, where you have the gap up, and then it breaks below the volume weighted average, and you go short and you have a huge gain. Everybody wants to capture these, but in reality, this trade that if I was looking at this chart and day trading, that would be kind of an easy thing to do, is go short, because you have this big gap up. You know, if you zoom out, it's been kind of range bound for a few days. You know, you want to, it's kind of easy to take this short trade, and in this case it would have worked, but what this data shows is that that's not normally the case. Here's another one that would have worked out well. Everybody wants to capture these, but when you start adding in all the other cases where it doesn't work, it just is not profitable. And so flipping the buys and sells seemed to help, had a positive impact, but still not enough to make this algorithm something that anyone would trade. So what had kind of very little or nominal impact or zero impact was using limit orders to get out when you have a certain profit target. That did not seem to help. And then using stop did not seem to matter as well. I mean, it helped a little bit, but not a ton. And shmooing the stop is really what I meant. Didn't really have a lot of impact. Removing the stop seemed to help on, what was it, the long trade, but nothing that really makes it helpful. So kind of let me just summarize where we're at. So what we've done is I took my, this friend's email of a strategy idea. It kind of made sense, and I thought it would actually do a little bit better than it actually did. But what seemed like a good idea is really not a good idea according to the quant analysis that I've done. I tried quite a bit to get it to work. I tried with a stop, without a stop, shmooing the stop. We tried with a limit, without a limit, shmooing the limit. We tried changing the window size to be everything from 30 minutes all the way up to a few hours. We modified the gap size of what would trigger a kind of, this is a gap up or this is a gap down. And then we even did the opposite trade in the end. And so the next steps, if this was an algorithm that I was really working on and considering to add to our portfolio, the next steps would be that I would stop. There'd be no further analysis needed. The results were extremely negative. And in fact, the one thing that might be worth considering is to look at a strategy that kind of does the opposite. So we could tell pretty early on that if you did the opposite, the profit factor went from 0.77 to around 0.9. So that shows that doing the opposite actually is more the right direction to go in. And I think what that just kind of confirms other studies that I've done that show in general when you have strength, it's better to buy into that strength on some kind of a pullback. And then the same is true for doing the opposite on weakness and basically shorting the market on weakness. And that's actually consistent with two of the day trade algorithms that I do have, that we have as part of our portfolio. The day trade long and the day trade short, what they do is when you have a gap up, they actually go in the direction of the gap and they have a tight stop. And then when you have a gap down, they go in the direction of the weakness. So those are the two, the breakout day trade long and then the short day trade. And you can go to our website and see the videos on those algorithms. Those are part of the portfolio that we actually trade in the S&P Crusher. And I guess I got a little sidetracked there, but yeah. So of note is that the opposite seems to be kind of the better trade. So I think that kind of summarizes what I wanted to do, which was basically analyze this VWAP, which is the volume weighted moving average or average price. If you are watching the video and you have an interest in algorithmic trading, I welcome you to look at our website, look at the portfolios that we offer. I'm the lead design engineer with Algorithmic Trading and also the owner and lead developer. So I'm kind of the guy that started the company. And what we have is 7 strategies that trade the E-minis, and all the strategies that we use have undergone similar analysis to what I've done here, only quite a bit deeper. Because if this algorithm had any promise, let's say after doing this we had a profit factor of 1.3 or 1.4 or 1.5, maybe even 1.2, then I would look at it a little bit closer to see if it has any more potential. And if it did, then there's a lot of other things that we do. So we change the inputs around, we optimize it, but we make sure that we're not over optimizing, so we only change a few variables on the inputs. We'll do what's called a walk forward analysis, which is another kind of in-depth way to see how the algorithm does on an in sample and then out of sample period. We'll mull it over to make sure that it just makes kind of logical sense on why it would work, and that it's not just some random pattern that we found. We do everything we can to try to break the algorithm to see if we're missing something. And then once we've done all that, then we'll we'll trade it live in most cases for anywhere from a month to 6 months, and then once we've kind of got that final stamp done, then we will also analyze it to see how it does in up markets, down markets, sideways markets, to see if it fits any need that we have in our broader portfolio. And then if it passes all that, then we will potentially add it to our portfolio. We'll also look at how it does with options potentially. So that might be another way to analyze this algorithm, would be to see if instead of shorting the market, what if you bought puts, or what if you sold calls? What if you did an iron condor on this? So we do all that analysis, but the final result is we offer our portfolio to be licensed so that you can trade them with an auto execution broker if you want. Just keep in mind though that trading futures options that involve substantial risk of loss, it really is not for everyone. But for active traders, investors looking to do kind of quant trading, then we welcome you to check us out. We have an A+ rating with the BVB. We've been around about 3 years now, and we're doing our best here to provide, add value to the quant community. And I'd like to continue doing these kind of analysis of various strategies. I did one on a MACD strategy that you can find on the website. This one is with the VWAP plus a gap. If you're watching this and you have some other ideas of strategies that you'd like me to look at, feel free to send me an email, and when I have time I'll do my best to code it up and do a video kind of like this one. But I guess I'll just close it out now. Just keep in mind all this was based on back testing, and if this was a strategy that we were offering, we'd have a ton of other disclaimers regarding the back testing and the hypothetical accounts. But I hope this was helpful to people that are maybe new to quant analysis, or people that have never even heard of it, or we're just curious of a volume weighted strategy using a kind of a sequence of events, in this case requiring kind of a gap up. To the developers out there, maybe the state machine is helpful for you if you've kind of been looking for an easy way to code sequences of events. That's what I use. With that, I'll close it. So thanks, and have a great day, and I wish you the best success in trading. All right, bye-bye.